Hey everyone, in this video we are going to talk about how to design a whole life insurance policy for maximum cash value. If your goal is to get the most cash value from your policy, you are in the right place. So what are the core benefits of a whole life insurance policy? Number one, it's safe. Your money isn't tied to the ups and downs of the stock market and it will grow every year. Number two, it's liquid. This means you can access your money whenever you need it through loans or withdrawals. There are no age restrictions like you have with a 401k. It's a great place to put money you want to keep safe but still want some growth, for example, your emergency funds. And number three is tax-free. You can access the cash value tax-free through loans while you are still alive, and the death benefit will be paid out to your beneficiaries without any income tax. Now here's the cool part. When you pay money into your policy, you can decide where it goes. It can go towards the base premium or paid up additions rider, also known as PUA. The base premium is the part which buys you life insurance or the protection. For example, if you pay $10,000 per year towards the base premium, don't expect to see much in cash value in the first or second year, depending on the product. This is because the insurance company overcharges you upfront for the death benefit. But starting from year 2 or 3, again, depending on the product, you start to see some of the money coming into your cash value. Now, the amount of commission an agent gets depends a lot on the base premium. The higher the base premium, the more commission the agent earns. Then we have the paid up additions rider or PUA. It's usually called a cash dumping because when you put money here, it shows up in cash value almost right away. If you pay, let's say, $10,000 into the PUA, you might see around $9,200 or $9,500 show up in cash value in the first year. This money is accessible right away and begins to earn interest and dividend, which is key to maximizing your cash value. Now, wouldn't it be great if we could put all our money towards the PUA and not the death benefit? Unfortunately, we can't go that aggressive due to certain limits. In fact, there are 2 limits that we need to consider. Number 1 is the insurance company limits, and number 2 is the IRS limits. Each insurance company has its own rules. For example, some of the big companies might let you pay up to 10 times your base premium in PUAs. So if you have a base premium of about $10,000, you could potentially pay up to $100,000 in PUAs. Other companies have a limit on the amount of money you can pay into PUAs. So different companies have different limits. Then there are the IRS limits, specifically the Modified Endowment Contract Limits, also called the MEC limit. Every policy has a MEC limit, which caps how much money you can pay into the policy per year. If you want to pay $10,000 per year into your policy, then the MEC limit has to be set to at least $10,000. The 2 main factors that control the MEC limit are age and the death benefit. Now, once you cross the MEC limit, your policy will be considered a Modified Endowment Contract or MEC. If your policy becomes a MEC, you lose the tax benefits. Your cash value still grows tax deferred, but the withdrawals are subject to income tax and a 10% penalty if you are under age 59 and up. You really don't want a MEC if you are considering borrowing from your policy. To maximize cash value, you need to keep the base premium low and put as much as you can into PUA. Let me say that again. Keep the base premium low and put more into the PUA. Like I mentioned earlier, different products have different limits. This means a low percentage in one product might not be considered low in another product. Here's a quick example. A 35-year-old male who wants to contribute $20,000 a year for 15 years. Same person, same company, same product. We are going to look at 2 scenarios. In the first scenario, we are looking at an all-base design, which means we are paying the full $20,000 towards the base premium. In the second scenario, we are going to set it up for maximum cash value. And this means that we are going to go as low as we can in base premium, and then everything else is going to be thrown into the PUA rider. This is going to show you the importance of policy design when it comes to a whole life insurance policy. So let's take a look. This is the first scenario, all base design. The full $20,000 is going to the base premium. When we look at the first year, cash value, not so strong because like I mentioned earlier, the insurance company overcharges you upfront for the death benefit that they provide. But we can see the numbers right here. We are going to look at a side-by-side comparison in Excel, but this is just to show you what a design looks like. Let's go over to the second scenario as well. This is the second scenario where we are designing with a lower base premium and everything else going into the cash value. So we can see we have a little over $1,800 going to the whole life insurance, which is the base premium, and everything else left is going to be our PUA or paid up additions rider. Now I want to be clear that about $300 of this payment is used to buy the 1-year term insurance that helps us to get the necessary max space we need to put in $20,000 into this policy. In the first year, you can see that the cash value is very high right off the gates, right? Very good. Enough liquidity should something come up, you are able to access this money. And also it makes this money available, ready to grow. And that is what we really want to see in a policy design set up specifically for maximum cash value. Let us take a side-by-side comparison of these numbers. I think that will make it a little bit easier. So here we have a side-by-side comparison of these two designs. We can see on the left side is the 100% base premium, and on the right-hand side is the maximum cash value design. So 20,000 going in over a period of 15 years. And we can see that again, the start cash value is very small because insurance company is charging upfront. We do not break even until between years 16 and 17. So by 15 years, we put in $300,000 into this policy, and we don't get that amount in cash value up until between years 16 and 17. Not so exciting if your goal is for maximum cash value. But now let us look at the other design, a properly set up policy here. You can see that we start out very strong, over $16,000 available in your policy, and we break even somewhere between year 5 and year 6. By year 6, we have $120,000 paid into the policy, and we have a little over that in cash value. So this is what we want to see, very strong. And right from there, it just gets better. Now, one of the things you can see, obviously, is the death benefit that we start out with is higher in the 100% design than in the cash value. But over time, because the cash builds up quickly in the properly designed policy, we can see that at some point, the death benefit in the proper design will surpass the death benefit in the base premium. One thing I forgot to mention is that you have flexibilities with PUAs. You can adjust your payments up or down over time, depending on your needs. If something comes up, you're not required to make that payment. But with a base premium, you have to pay it no matter what. Some agents have various reasons for preferring a higher base design. Some might even try to scare you by saying that your policy will become a mech if you go with a low base design. Remember, a higher base design is in an agent's interest because it pays a higher commission. It's important for you as a consumer to educate yourself and decide what's best for you. At least ask for different designs with varying base premium and PUA ratios and choose the design that makes the most sense for your needs. If your goal is maximum cash value, make sure your policy is set up for maximum cash value. And that is where buyer's remorse sets in. People hear about these products, they're excited about it, they buy the product, but then some way, somehow, they are sold something else. And when they begin to realize what has happened, they begin to feel sad about this product. I don't want you to find yourself in that situation. And so make sure you are working with people who are happy working in your interest and setting up these policies to meet your needs. So that's a quick overview of how to set up a policy for maximum cash value. If you found this video helpful, please like and subscribe to my channel. In fact, drop the word value in the comments section. If you have any questions, feel free to reach out anytime or just ask in the comments. And as always, I hope this helps. Thank you for watching, and don't forget to like and subscribe for more videos like this. Bye.